Hey, good morning, everyone. Good morning. Hey, is there anybody there? I see Ethan.
Yes, good morning, Professor.
Yeah, good morning, Ethan. I see Andres. I see Luis. And I see Yen Chu. How's everybody? Only 4 people, huh?
Good morning.
Good
Doing very
morning,
well.
Yen
How are you,
Chu.
Professor?
Good morning, Luis. Now, before let me check, before we start, let me check how many people are in today's forum. We have 5 people in today's forum. So if I have 5 here, yeah, the numbers match. Yeah, numbers match. Good. Yeah, and let's hope other people will be joining soon. Okay, let's hope other people are joining shortly. And let's see, today actually the main lecture is in topic 5, real options. Okay, that's today's lecture actually, right? Main lecture. We are kind of, we are far behind, but we're gonna catch up very soon because the rest of the topics, I mean, we are, as you understand, we are just into we have just begun on the fundamental analysis, the ratio analysis, right? And then after ratio analysis, these other topics are relatively easier. So there will be, we gotta finish up really, these things were already, covered on October, the first week of October, but by the main lecture. But we need to recap, right? Just to make sure. And we have how many people here now? 7 people. Now, let me just quickly check what we October 16th, right? Let me check October 16th recording just to make sure. I believe we got started on the profitability ratios.
Is an engineering term. Have you guys ever heard of white noise? What's a white noise? You know what white noise is. What's a white noise? And current liabilities. But in capital doesn't mean capital is different,
Yeah, we got
right? As a what's that? Figurative. In a figurative.
Okay.
Current equity.
All right. So
what does this mean?
We basically, since I'm sharing the screen, we were here, right? And I just tried to give you the concept of output to input ratio. I was trying to explain what it means, right? What these ratios mean, and these ratios are all about output to input, because output to input ratio measures the profitability, productivity or the efficiency, right? And So before I go back to that, let me quickly also explain, because there is something that came up here. Um, First of all, in your we did this, but we called it. Now this is what they call common size statement. What's a common size statement? Basically, when we have two companies, right? They would have different um, different revenue. They have different total assets, right? Different, in other words, the numbers in the income statement and the numbers in the balance sheet will be grossly different. I mean, it will be hugely different because depending on the size of the company, right? Depending on the size of the firm, and what did I say? Firm size is determined by mainly by what? Can anyone answer this? The firm size is determined by what? When we say, firm size, what does that mean? Anyone? When we say firm size, say that again.
Is it equity?
Oh, Anna. Yeah, equity is part of it, but equity alone doesn't, I mean, that's not enough. Equity alone is not enough. Think about it. Equity is part of what?
The net profit?
No. Yeah, equity. No. Net profit is part of, net profit is, additional equity. I mean, net profit is, net profit is the difference between equity at time 0 and equity at time 1, right? Net profit is what makes equity at time 1, because equity at time 1 is equity at time 0 plus EAT, right? Look, but equity is only, it's not EAT, is net profit. In other words, EAT is internally generated capital, not paid in capital. So that's what makes the difference between equity at time 0 and equity at time 1. But I said equity is only part of what? Equity is a part of something. And what is that something? I don't know why. This is very basic, and you guys still don't. You guys are missing it.
Owner's equity.
What's the difference? I mean, is there any equity that's not owners? Huh?
I guess not. Yeah, you're right. My bad.
No, please think logically. Think logically. Is there any? I mean, equity means it's owners basically, right? So whether you call it owners equity or just equity, it's the same thing, right? It's just like saying, doorknob or knob or door. Of course, there could be something different, right? Different knob, but it's like. But think about it. We already know this is something that everybody should know. Isn't this what this is? Accounting equation, what they call accounting equation. But that's what balance sheet, all this time, that's what the balance sheet is telling you. Total assets is equal to debt plus equity. What does that mean? Equity is part of total assets. Isn't that right? Equity is part of total assets. Isn't it right? Debt is part of total assets.
I was thinking
Huh?
assets, but then I was like, I don't know. I was just overthinking it.
Maybe it's early, Saturday morning. Because it's Saturday morning, your brain isn't yet, to its, I mean, you gotta warm up the engine, right? You gotta warm up the engine, and the engine is, before fully warmed up. I mean, these days it doesn't happen that much. Old cars, the engines must be warmed up. Otherwise, hiccups, engine hiccups. Now think about it. My question was, what determines the size of the firm? What determines the size of the firm? And you said equity. I mean, Anna said equity, but I said equity is only part of the total assets. Then what determines the size of the firm?
The total assets?
Yes, the total assets. Yes, total assets determines the size of the firm. Okay, so finally, the first person that got it right, after all. And who was that? Anna? Was it Anna?
Yeah, I was thinking the person.
Okay, Anna. I'll give you 0.25. Yeah, total assets determines the size of the firm, right? Why? Because from total assets, what is determined? The size of the plant and equipment. Right? You all know total assets break down into current assets and non-current assets. Current assets are liquid assets. They are basically liquid assets. So it's just in the form of cash flow, right? But then think about it. Non-current assets, that's what's important, right? Non-current assets, I cannot just take, okay. Right? Non-current assets, it's plant and equipment and building and land. Right? Then think about it. What's happening? Erase. Why can't I erase it? Okay, I'll simply rewrite it. Building and land, right? Now, look, plant and equipment determines what? Production capacity. Isn't that right? The production capacity of the company is determined by the size of the plant and equipment, right? in case I'm talking about manufacturing, right? But the manufacturing is the backbone of the industry, an industry of the economy, an economy that just as retails, that economy is actually buying from another economy that's manufacturing. So retail is not the backbone of the economy. If think about it, they cannot import from another economy that manufactures something, right? That makes something, right? This economy is only dependent on the import, and if they cannot import for one reason or another, right? Think about it. The U.S. The reason that the entire world is always suffering when there is something, uh, internal struggle, I mean, regional conflict in the Middle East, the entire world suffers. Why? Because Middle East is the main producer of oil, and the rest of the world depends on it. Of course, U.S. has huge oil reserve. U.S. is the largest oil, not the producer, but the largest uh, country with the largest endowment of oil, natural. U.S. is not simply, pumping up all of it. But think about it: when Middle East runs out of oil, U.S. will still be, okay, because U.S. has a lot of oil reserve under the ground and in the offshore, right? Offshore area. Shale oil, which is, in 1990, it was during the Obama administration. They discovered huge oil reserve in the shale layer of the underground shale layer in the offshore, right? Underground system. And that alone, at the time, the estimate was, it's going to last, the amount of shale oil reserve in the shale layer is so big enough to last for the next 200 years, right? So that's how much, oil there is in the U.S. But still, U.S. imports oil, not, because in the future, right? And the oil is, think about it. To a country that doesn't have water resource, water can be a weapon against that country. To the countries that don't have any oil, right? Oil can be a weapon against that country, right? Especially clean water is more important than oil. It goes without saying. So an economy must produce something. Therefore, manufacturing is the backbone of the economy. Look at the countries that are thriving and economically developed. A country like South Korea, main powerhouse of technology. Japan used to be, in the 70s and 80s, even until 90s, Japan was the powerhouse of the technology. But it doesn't seem, it is still, but not as much as before. You might think China is the power. Yeah, China is powerhouse as well, but instead of they are trying to chase South Korea. Taiwan, China are trying to chase South Korea in terms of high tech. But still, in terms of high tech, but China does a lot of industrial spying. They pay huge money to the engineers of other countries to bring them on board, right? So then that's basically industrial espionage. And of course, the people who are defecting, I mean, those who are working for, let's say, Samsung or LG, but got huge money offer from Xiaomi or some Chinese tech firm, and if they ditch their job and then defect to Chinese company with the technology, with the files and copies of all these, with huge files that are like top secret to these companies, Samsung or LG, and if they defect to a Chinese company, they, of course, they will be. There's huge amount of money involved in it. And they will be, if they come back to their home country, then they will be prosecuted, right? That goes without saying. But sometimes they offer money like hundreds of millions of dollars, but that is how cutthroat. That is how how stiff and cutthroat the competition is in terms of who is going to be the dominating power in the economy in the future, especially in high tech. Because think about it, plant and equipment, right? This is the backbone of the economy, plant and equipment. And remember, plant and equipment, it determines this output capacity. Size of the plant and equipment determines output capacity. What does output capacity mean? That's production capacity. That means production capacity. Production capacity or production level, right? That's maximum. That means how much they can produce, how many units they can produce, right? And then I've been telling you, production capacity is very important. Why? Can there be a company that is small but still? Can there be a company that is small and that can still thrive? Yes, it's possible. A small company, but think about it. If it is a small company that makes parts and components, let's suppose something like a smartphone, and there are two major smartphone manufacturers, right? Of course, in China there are some Huawei. How do they? Huawei. Yeah, Huawei and Xiaomi. But they are, like not number one and number two. They are more like number 3, 4. Number one and number two are, of course, Apple and Samsung. And in South Korea, there is also LG, which is also a global. But they lost competition to Samsung in South Korea already. I mean, they are still putting out their new models in South Korea, but globally they are like even I mean technology-wise they are very good, but they became smaller. I mean, a less dominant player in the market than even the Chinese companies. And but let's say there can be, I mean, small companies that are supplying chips to these, phone makers. It's called foundry. Foundry is, in the old days, foundry was like a steel mill where they, with the furnace, right? With, what furnace is. It's not the furnace at home, but, furnace, a very, huge, furnace where they melt the, the raw material, the steel, the iron, steel, and raw material, and they turn it into a steel plate. That was what they used to call foundry. But these days, foundry means a chip maker, microchip maker. So there can be a small foundry. I mean, specializing in a particular type of chip, and they can thrive because they have, they are small companies, but they have their own strength, right? And then, but they supply these chips to Samsung, or to Apple, or there is a Taiwanese company called TSM or TCM, which is a chip maker basically, but it's a huge chip maker, huge company. I mean, think about it. Between the same, the companies on the same level, in the supply chain, right? So the phone manufacturers versus phone manufacturers. I mean, Apple and Samsung, they are at cutthroat competition, right? Huawei, Xiaomi, Samsung, Apple, they are all in a cutthroat competition, right? But you understand, the chip makers are not in direct competition with these phone makers. So small companies can thrive if they have specialty, right? But basically, if everyone is making the same thing, then everyone is all in a stiff competition. And they try to think about it. If there is a new smartphone manufacturer, right? New smartphone manufacturer. They are new, so they are startup. If they are startup, they are small. If there is a new smartphone manufacturer starting up now, and if they are small, then they will, obviously, they can't last very long. Why? The big guys like Apple, Samsung, or Huawei won't just watch this small guy grow. Right? Because if they let them, huh?
Sorry, I should have raised my hand, but I was gonna say, what if they get some good VC money?
Yeah. Well, they can get some, VC money, but that doesn't mean the VC money suddenly, just because they get VC money, suddenly they will be like the size of Samsung, or they cannot be. The VC investment, VC capital cannot be more than, I mean, the size of Samsung and Apple, they are like trillion-dollar companies. Apple is $2 trillion. $2 trillion means what? The total assets, actually, total assets must be greater than 2 trillion, because 2 trillion is just the market capitalization, right? Apple's market capitalization is like 2 trillion, meaning that's the market value of the equity alone. Market value of the equity alone, right? So the total asset size would be more than that, total asset size would be bigger than that. But that total asset size, a lot of the, total asset size of the total asset is in plant and equipment. So that's why Apple can have such a mass production, capability. Also, Samsung would be like $1 trillion as well. Maybe not 2 trillion, but as probably 1 trillion or even closer. Maybe not 1 trillion. It cannot be, because total GDP of South Korea is about 1.8 trillion. Samsung probably several $100 billion. But size of the total assets determines the size of the production capacity. And they have mass production capacity. And what kind of venture capital has the capability of investing like hundreds of billions of dollars? That would be almost first of all, this is a startup, so it's a risky venture. Maybe they can invest up to something like $1 billion. Still, for a venture capital, billion is a not an easy amount of capital. Venture capital must raise, capital from wealthy investors, right? Even, Jeff Bezos is worth $200 billion. Jeff Bezos alone, maybe, can, single-handedly invest like, like $10 billion into this startup. But, it's always the startup is a big question mark, right? So the amount of capital they can get invested is, probably in the order of not that much. I mean, it won't be in the order of, billions of dollars. It may be in the order of, tens of millions of dollars, but not, billions, hundreds of millions of dollars, or, billions of dollars. But, the point is, if there's a small company, right, that startup, the big companies won't just watch it hands down, because as the small startup grows, they are taking over the market share from the big companies. Think about it. The market share is not an infinite resource. You understand? Think about it.
I was going to say that's why companies like Amazon, they buy out their competition, right?
Exactly. And who was that? Who?
That was me.
I raised.
Who said that? Lewis?
No.
Was that Lewis?
Richard.
No, that wasn't me.
Richard, yeah. Richard, yes, of course.
I was
Because
thinking about
it's,
how they bought out. I think it was like a company that was they were selling diapers online, and Amazon ended up buying them out pretty much because it was competition, and then they pretty much took over.
Yeah. Look, if you okay, Richard, you got 0.25 for that. Look, no, market is not unlimited or infinite. It's not an infinite thing. Market is limited. Why? Think about it. Market for Amazon, for example, market for Amazon is 300 million people in the U.S. 300 million people in the U.S. Maybe Canada included. What's the population of Canada? Probably Canada's population is not even 10 million. I don't think Canada is even 10 million. But look, it's a retail. Amazon is retail. It's not a manufacturer, right? So then retail is basically B2C business, not B2B. You understand? B2C. And then if everyone in North America is buying from Amazon, right? That's about 300 plus million, right? Then the market is saturated already, right? Now between and of course Amazon is online, then Amazon's biggest competitor would be Walmart. Walmart is offline, right? But think about it. If Amazon gains 1%, I mean, out of this 300 million people, not all, not 100% of them is buying from Amazon. Someone is buying from Walmart. So the market is split between, let's say, Amazon and Walmart. So let's say, of course, I can buy from Amazon, but I can buy something else from Walmart as well, right? But look, for the same thing, if I'm buying, let's say, a phone case, right? A phone case, right? Protective phone case. I need only one. And for that one phone case, I won't be buying it from two, right? I won't be buying it from two sellers. I will just buy it from one. So even if the phone case is only $5, that $5 is being spent, is going to only one of them, either Walmart or, right, or Amazon. So think about it. If 60% of the North American population is buying from Amazon, and 40% is of the population is buying from Walmart, right? Then if Amazon is gaining 1% more market share, what does that mean? Then that is coming from Walmart. That 1% is coming from Walmart. Now then, the market share of Amazon is 61%. Walmart's market share is 39%. Make sense? If Walmart is gaining 1%, that's coming from Amazon's market share. Now think about it. The market geographically, market is limited. Demographically, maybe it's in flux. I mean, some teenagers. I mean, teenagers is a target. Let's say by age group, teenagers is a target sector. Baby boomers are target sector. They have a different market segmentation, right? Different market segments. Now for teenagers, let's say Amazon is you can't. It's always in flux, right? You can't say some teenagers may. I mean, think about it. Teenagers are not forever teenagers. They become from teenagers to young adults, right? From young adults to 30 somethings, right? And as they grow or as they age, their tastes change, and sometimes, and so the teenage population may change. I mean, in some countries, where the population is aging, there's less birth than the death, right? Birth rate is less than the mortality rate. Then in such a country, the population will look like an inverse pyramid, right? And in such an economy, right? In 1990s, teenagers were, let's say, 20% of the population. But in 2000, teenagers are 15% of the population. 2010, teenagers are 10% of the population. 2020s, teenagers are 5% of the population. I mean, think about it. In Africa, teenagers are actually the biggest part of the population because the mortality rate is high, and some regional conflicts, like the males between the age of 20 to 50 are, easily dying. But think about it. Although demographically, the markets are in flux, right? But geographically, markets are limited. And your market share is, so think about it. If there is a new smartphone manufacturer or startup business, right? And they are small, and they are each year they are gaining, their market share is inching up. They are gaining 1% more, incremental 1%, then Apple and Samsung's perspective, what is this small company is not candy in their eyes. Clearly, it's not a pleasure to see this company, because if they are gaining 1% more, 2% more market share, then that means it's they're losing 1%, 2%. So big industry giants buy them out. I mean, when I say they kill it off, that means, how do they kill it off? Huh? They send some gunmen and gun down these people, bomb the company. No, they just simply buy out the existing owners, existing shareholders. But that's what it is. That's why the market share is important. That's why the production capacity is important, right? And what did I say? Production capacity is determined by the size of the plant and equipment. And the size of the plant and equipment is determined by what? Total asset size. You understand? But then, just because you are a big company, that doesn't necessarily mean you are the most profitable company. I mean, you may be a big company, but in terms of profitability, small companies are usually more profitable. Why? The profitability and the revenue size have not very closely related. I mean, the bigger the company, the size of the company, right? Bigger the size, and so now think about it. When we say the size of the company, you might say, size of the, then how do you define, size of the company? Oh, the revenue, size of the revenue, number of people, number of employees. Yeah, well, those are, but if you can define the size of the company by that, usually, because, but most they talk about the revenue when they determine when they talk about the size of the company, they talk about the revenue. But then think about it. What's behind the revenue? Can a small company have a huge revenue? A small company, I mean, what is huge? It can be huge for its size, but look, Apple is a huge company. Already the size of their total assets is huge, right? Market capitalization, which is the market value of the equity alone, is like 2 trillion, which is like the size of the British economy. Smaller than British economy, but $2 trillion is, I told you, South Korea, GDP of South Korea is, about 1.8 trillion. $2 trillion revenue of 2 trillion is even bigger than the size of the South Korea. There aren't that many countries in the world that has bigger than $1 trillion GDP. Okay. Italy is only about 1.8 trillion. Italy. Spain is somewhere around 1.6 trillion, right? Countries like Denmark, Netherlands are very wealthy countries, right? Western European countries, very wealthy, but they're not even 1 trillion. Netherlands, right? Denmark, not even Sweden, Norway, not even 1 trillion, right? France is, I would say France is about 2 trillion, France. So revenue of Amazon, was it Apple or Amazon?
It was Apple.
Apple market capitalization. So in other words, market capitalization alone, in other words, size of the equity, market value of the equity alone, is almost as big as the size of GDP of France. There aren't that many countries that has more than 1 trillion. Only about 15 countries in the world. Only about 15 countries in the world. Okay, so a small company can be profitable, but that means profitable for its size, right? In sheer numbers, it cannot be the profit of a small company that makes chips for Apple. Its profit can be $50 million, but for the size of its total assets, let's say its total assets is 100 million. For 100 million, $50 million profit is a huge thing, right? It's like 50%. Think about it. If their total, we talked about ratios last time. So if the profit is net profit, so in other words, EAT. $50 million is unthinkable for a company. If EAT is let's say 10 million, net profit is 10 million. Excuse me. And then equity is of course EAT at time 1, equity at time 0 is 100 million. Okay, that so let's change this to 20 million. Come on. Okay. Now then, if you divide that by that, this is called return on equity, isn't that right? And the return on equity is 20% in this case, right? This is a very good return on equity because normally, ROA, return on total assets, if return on total assets is about 20 to 25%, that's normally the case of a profitable company, which means to have this kind of return on assets, what does that mean? If their total assets is like 200 million, that means 50% equity, 50% debt. This has to be, if it were to be 25%, that means their EBIT, right, should be like 50 million, right? Which is, it has to be EBIT, right? Not the, but so if the EBIT is like 50 million, they paid out 30 million as interest and taxes, right? They paid out about 30 million as interest and taxes. But again, if a small company has like 20% return on equity, or like 20% return on equity, that's a profitable company. That's clearly a profitable company. And if it is 20% or more, yeah, small company can be like that. But in sheer numbers, I mean, it cannot compare to let's say Apple. What would be Apple's return on equity? I don't know, but this is just a thought experiment. If Apple's return on equity, this one is Apple's return on equity is, let's say, 15%, which is not that bad. Think about it. Apple actually, this would be about what Apple would get, because over the on average, Apple over the last 5 years, I mean, every semester I collect Apple's data, and monthly returns were like the stock price data, and monthly returns, average monthly return was like on average like a 2%, and I use every semester, so every 6 months, so in the spring I collect the past 5 years, including like as of May, right? So this spring 2021, my data range was like May to May, or rather, to make it exact, June to May 21. So then, start point is, if the end point is May 21, 2021, right? Then the starting point is, June of 2016. So for 5 years, 5-year data, I collect 5-year data and monthly data. So then there will be like 60 data points. And this fall, so November, end point, because by about November, because after December, I cannot collect the data at the end of December. But then why? Because the class is over, I cannot show the data to the class, right? So the point where I collect the data will have to be November. That would be the latest point, or the point as late point as it can be, right? For that data to be useful to the class. But anyway, on average, Apple has been growing, right? On a 5-year timeline, on average monthly return was like 2%. 2%, you might say, doesn't seem. You might say it doesn't seem that big, but look, 2% a month compounded for 12 months, raised to 12. Annually, -1. Annually, it's like 27%. Annual growth, 27%. Annual return is 27%. But let's say 15% Apple's, return on equity is 15%. This 15% could be like, but then think about it. Equity alone is 2 trillion. Equity alone is 2 trillion. 10% of 2 trillion is what? 200 billion. Isn't it right? 200 billion. So for it to be 15%, it has to be 300 billion. Right? Makes sense? So, look. This is what the common size statement is all about. We did that actually in homework 1. I wonder if you remember that. This company, just by numbers, right? Their net profit is 20 million. Apple's net profit is 300 billion. You cannot compare these two, obviously. This company is too small, right? I mean, looking at the sheer number of 300 billion, the difference between this drastic contrast between 20 million and 300 billion, right? You can hardly imagine this small company is doing well. I mean, how can you compare 20 million to 300 billion? But is this company necessarily less profitable than Apple? No, you can't say that, because if we take the return on equity, this company is the return on equity of this company is 20%, whereas return on equity of Apple is 15%. 15%. Of course, this is, once again, this is not book value. This 2 trillion is not book value. It's market value. Actually book value would be smaller than this, but still even the book value would be at least 1.5 trillion, right? Couldn't be so this is why we need the ratios, and this is why we need common size statement. What is a common size statement? It's exactly looking at the percentage. It's exactly what, and this is called, this is called vertical analysis, if you remember. This is called vertical analysis. This was in, homework 1, vertical analysis and horizontal analysis. And I said, I don't like the term vertical analysis and horizontal analysis. Why? Just because it goes horizontally. I mean, the better term for horizontal analysis would be intertemporal analysis, because you want to see how the company did over 2 periods of time, 2 periods, right? Time 0, time 1, between time 0 and time 1. So that's intertemporal or dynamic analysis. Dynamic. Why? Because dynamic means change, right? You think dynamic is like, dynamic is like, what's that, break dance? Yeah. Dynamic means, dancing on the floor. Look, you can have a dance move only because there is time. Time flows. If the time is frozen, there is nothing dynamic. You understand? Because nothing can move. If time is frozen, nothing can move. If time static, right? You see, we can have a video, because video is a early motion picture is what? Static picture, still picture, and you take, like burst shots of still picture, every, 1/10 of a second, and then you connect them, and then you run run that film that are connections of each single shots, right? And then, on the projection screen, it is projected as if it is moving. But, each, that segment, each still picture is frozen in time. It's static. But, because there is time, it's moving, right? Dynamic means, in physics and math and economics, dynamic means change over time. Only because there's time, then there is something dynamic. Dynamic means change. Okay? Right? If you're dancing on the floor, because you are changing your position, and without time, your position is frozen. Isn't that right? Your move is frozen if there is no time dimension there. Right? You can only have dynamism, or you can only have dynamic um, you can only have dynamic picture only because your body moves from point A to point B through time, right? That's what. So horizontal analysis, the better term for that is dynamic analysis or intertemporal analysis. And this is vertical analysis. It's only because you are all line items are expressed as percentage of the revenue. Between company alpha, two companies, alpha and beta, if you look at the numbers, dollar values, beta is a very small company, and it's it has their profit seems mediocre compared to company alpha. But look at their profit. Look at their right profit margin. This is called profit margin because it's also called return on sales revenue. Right? They have a higher return on sales revenue or return on profit margin. Profit margin simply, right? So that's called common size statement. So in other words, vertical analysis is common size statement, another name for. And the whole reason for ratio analysis is this, right? You can compare companies of different sizes. So it's already 10:36, so we'll take a 10-minute break and reconvene exactly at 10:46. Okay, 10:46. All right, we're back. We're back. Um, oh, before we get back to our, am I not sharing? I thought I was sharing. What happened to my share application? Okay? I'm sharing application. Okay. So I don't know if you have noticed, but go to no. Midterm was posted, right? Everyone, it's been posted there. I mean, it was posted on October 8th. And where is that? Midterm instruction. Yeah, there you go. It was posted on October 18th, Monday. So this Monday, this was posted, right? And so you have midterm, which is actually going on now. It started on Friday until this Sunday. So you have 3-day window. How many of you have got started on this? Everyone listening? How many of you got started? Anyone?
I'm here, Professor. I haven't gotten started though.
Okay, yeah. You still have 2 days, right? Until, yeah. But don't forget to get started ASAP, because I mean it's better to get started early on, because if you run into any technical issues, right? And if you
I'm sorry, is that homework? I had to leave
no,
early
it's
last class.
midterm. It's midterm. It's the midterm. Okay. If it is, if you start.
I have a question. Are your grades updated on Blackboard?
Yeah, the grades are actually the first quiz. The result of the first quiz. Look, if you go into the assignments, right, you can see that midterm there, and quiz one results. Quiz one results were up on. This was obviously this. It was quiz one results with attendance as of October 2nd. So it was posted on October 2nd, or
okay,
right? So every time you have another exam, the cumulative result will be cumulative, cumulative statistics will be posted there, right? All right. So as I said, better to get a head start than late, because please don't start on Sunday night, okay? Because if you, some people, you have like, 2 hours or 3 hours to do it. Some people get started at 11:30. If you start at 11:30, there's no way you can finish it by 11:59. Okay, and even then, at 11:35, 11:45, someone sends an email. Professor, I have a problem. At 11:45, 11:50, if you send me 11:50 p.m., if you send me an email, do you have, can you honestly have any expectation that the email will be discovered by me at 11:50 p.m.? Then I will respond to that at 11:50 p.m. in time for you to fix it. I mean, if there's any technical issue, then I need time to fix it. So if you, let's say, if you run into a problem and you send me an email tonight, at least it can be discovered by me tomorrow morning, or at least by tomorrow afternoon, and then I will have sufficient, response time, and I can I can fix the, I can troubleshoot, or, you know, if worst comes to worst, I can reset that for you, and you will be notified with enough time to do it, right? Before the deadline of 11:59 Sunday, right? And you are all adults. I mean, you know, even if young, you would be like 18, I mean, or 19. At that age, you can think about the logistics, you know, logistics of things. Oh, if I send email now, when is the professor going to see it? When is he going to discover it? And you shouldn't send email to my BMCC email. It's been said from the day one. It won't be discovered at all if you send it to a BMCC email. Okay. So any rational person would have that sense of, you know, have that idea about logistics. You know, what will be the reasonable time that this email will get discovered, right? And then what will be the reasonable time for the professor to respond to that? Or what will be the reasonable time frame for the professor to fix the problem? And then that's not all, because after fixing the problem, you should be allowed also, you should have sufficient time to do it. Then obviously it's a nonsense if you send email at 11:50 p.m. or 11:30 p.m. Sunday night, right? You can't, you know, it's obviously that's a nonsense. A rational person wouldn't do that, right? All righty. So okay. So then, you know, I would like to start on the okay. But before I do that, right? In the ratio, in ratios, there are 5 ratio categories. Five ratio categories. Those are first, profitability. I'll just stop there because it takes too much time to write. And then the first one is profitability category. Second one is liquidity category. Third category is asset management. Asset management. Fourth, debt management. Fifth category is market valuation categories. It's called market valuation or stock valuation category, but let's just call it valuation category, because valuation of what? Of course, stock, right? Valuation. And each category, there are different numbers of ratios. Sometimes, you know, profitability category has the most, probably, you know, it would have like 5 ratios under this category, 5 ratios. Maximum of, but, you know, we will look into mainly 2 most representative categories. So first is return on equity, return on capital, return on assets, and return on sale. But we will look into return on equity, and we already know that, I'm not going to talk more about this because I already used it in the example. In the liquidity category, two major representative ratios are current ratio and quick ratio. Okay, quick ratio is also called acid test. And the in asset management category, two most representative ones are inventory turnover ratio. Inventory and then fixed assets turnover ratio. And then in debt management ratios, two most representative ratios are times interest earned ratio. You might wonder, if it is times interest earned, shouldn't it be T? But yes, it's not, but it's not X. It's literally times, multiplication times, right? That's what, because I'm going to talk about this later. And then debt ratio, total debt, it's called simply debt ratio, but it goes by many different names. It goes by different names. Debt ratio or leverage or total debt to total assets ratio. But that's obvious, right? That ratio already, it obviously from the name you can tell is the ratio between total debt and total equity, total assets. I'm sorry. Come on. And in valuation ratio, right? Market valuation ratio, it's, two things. Price earnings ratio and market price to book value ratio. Okay. Now, so let's first talk about. We already know return on equity and return on assets. Return on equity is, EAT, net profit, right? It's so hard to write. EAT over equity. And this EAT means, EAT at time 0, at time 1, and equity at time 0, right? And then return on assets. Of course, it's EBIT, right? It has to be. EBIT is sometimes they use EAT, but EBIT is more appropriate numerator for that. Okay, over total. Now, I explained the difference between capital and asset last time. Capital means, only, look, assets, assets are debt plus equity, right? But then we know what's happening. Well, I didn't. Okay, get bigger. And where was I? This is crazy. Oh, okay. All right, so I got it back. Ah, why is it doing this again? Now, I'll just, verbally say that. Where is it again? Okay. All right. So we know okay, I got it. So, Now, when we say capital, right? Capital is always long-term. It means long-term long-term capital. In other words, equity is long-term capital. Equity is always long-term, right? Because you don't have to. Equity doesn't have any time limit, isn't that right? Equity doesn't have any maturity. In other words, stocks don't have any maturity. Stocks can go on forever, right? As long as the company doesn't shut down, stocks go on forever. Equity is already long-term. But debt, there is short-term debt, which is called current liabilities, and long-term debt. Non-current liabilities, right? Short-term and long-term. So think about it. When we say capital, that's what that's what is meant by long-term debt and equity. So there will be a difference between return on assets and return on equity, because return on assets, something's missing here. Return on assets is EBIT, operating profit over total assets, right? Oops. But return on capital is then, it's getting so. So then you get the idea. I mean, I'm constantly disrupted by this, whiteboard malfunction. Okay, I'm gonna have to. Come on. Oh, yeah. So the thing is, return on capital only has long-term debt in the denominator. Okay, so return on capital is then EBIT over long-term capital only, which is long-term debt and equity. And of course, the EBIT we are talking about is EBIT at time 1 and long-term capital at time 0. And return on sale is also called, return on, it's also called the profit margin. It's EAT over revenue. And then this is revenue. They are both, time 1. Because the revenue, this is purely from income statement. And in the income statement, this is simply the ratio between the net profit and the sales revenue, right? So I wouldn't even use any time subscript here. It's unnecessary. All right. Now, and you get the, because in our last class, I used the gas mileage analogy, right? Analogy of the gas mileage, right? It's like input to output ratio. And if we go back to Okay. Here I used, C. Capital, the symbol for capital is K. Okay, symbol for capital is K. Even I mean, it doesn't have to be German, right? I mean, in German, capital is K. Starts das Kapital. It starts with K, but in English it starts with C, but doesn't matter. Symbol for capital is K, right? C is the symbol for cost, so we can't. And because return on equity is the biggest concern for the shareholders, and think about it. What did I say? What did I say is the goal of the business? I mean, any business. What's the goal of the business? Anyone? What is
maximize shareholders' profit?
Yeah. To maximize profit. To maximize profit, right? And to put it, and was it Anna?
Yes.
Who was that?
Yeah,
Anna?
it was me. Anna.
Okay, Anna, you'll get another 0.25. Yeah, to maximize profit, but they put it. That was that was the expression. That was how they put it back in the like 50s and 60s. But since then, the expression was tweaked a little. The definition was tweaked a little to maximize the shareholder wealth or shareholder value. And what is shareholder wealth? What is what is meant by that? Shareholder wealth or shareholder value? Shareholder value and shareholder wealth means value of the equity. Think about it. Total equity divided by number of shares. Total equity divided by number of shares is what? Book value per share. And you understand, equity at time 1 is the result of equity of time 0 plus EAT, net profit, at time 1. So then, the more profit the company makes, that profit is, contributing. The profit is contributing to equity at time 1, right? If you maximize profit, that will maximize the stock price. That simply means, it will maximize the stock price at time 1, which is the shareholder value or shareholder wealth. Isn't that right? So that's why return on equity is most focused. But you can understand. I'm not going to repeat this. Last time I talked about output to input ratio. If you think about it, it's all output to input ratio, and you can think of. Suppose you have, you can think of equity or total assets, especially total assets. You can think of it as a tree. You can think of total assets as a tree, a fruit tree. Let's say you have this tree, right? And you bought this tree. But when I say you, it means shareholders, right? Shareholders and shareholders. So let's say this tree is $10 million. This tree is $10 million. It's possible. I mean, the tree bears, like golden fruit, right? Golden fruit. It's not only shareholders, there are creditors. But creditors just lended money. They don't, in other words, creditors, and suppose there are 10 shareholders, 10 shareholders, and so let's say from shareholders invested 6 million. Shareholders footed 6 million. Creditors then means 4 million came from the creditors. You bought this tree. And then 1 year later at harvest, this tree will bear fruit, right? This tree will bear fruit. And let's say, so it bore, right, 1 million, 2 million fruit, 2 million. 2 million fruit. And let's say each fruit is sold for $1. Each fruit can be sold for $1. That means, its total its total revenue is $2 million. But let's say this revenue is exactly profit. Let's say there was no, of course, let's say to make it more plausible, right? 2 million fruit, but they are sold for $2. They are sold for $2, right? Then the total revenue will be $4 million, right? Total revenue will be $4 million. But after paying for expenses, you had, fertilizer, you had, tractor, you had, expenses that went into tending this fruit. After paying that, you have $2 million in profit. Okay, which is, net profit, EAT in other words. But, regardless of, don't forget about the dollar value, but, the point is 2 million fruit, 2 million fruit is your, 2 million fruit is your, is the output of this, right? 2 million fruit is the output of this tree, and it belongs to, eventually it belongs to the shareholders, right? Why? First of all, creditors don't have any claim to the profit. I mean, creditors got their interest. Creditors got their interest payment. In other words, from 4 million, right? They paid out expenses and interest and taxes, right? From the revenue of 4 million, they paid out interest and taxes, right? CGS, cost of, direct cost and indirect cost. So out of this revenue of 4 million, right, 2 million is direct cost, indirect cost, right? CGS, the picture gets more. CGS and operating expenses, and then interest and taxes. So paying out all of that, right, which is 2 million, then you end up with $2 million in profit, right, net profit. Now think about it. The creditors got their interest, so no longer they have any claim, right? They don't have any claim anymore. This 2 million, right? 2 million fruit, or $2 million belong to the shareholders, right? So basically, a company, a firm
Professor,
is
quick
like,
question.
yeah.
So what if they default on the loan to the creditors? Then it changes around, correct?
As long as they have, look, as long as they have, as long as they have EBIT, right? Positive EBIT, which is greater than, that's where the times earnings ratio comes. That's where the times interest earned ratio comes in. They won't default as long as their EBIT is greater than the interest payment, right? They won't default. Okay, but if it is the other way around, it will default, of course. But then and what is your question? Your question is what's gonna happen if they default after that? What's gonna happen after default?
Well, you were saying that the I guess the profits are not for the creditors, and they're for the shareholders. So
Yeah,
but if
yeah,
they
yes, of
default,
course.
then at that point it would be the creditors, correct?
Well, first of all,
Never mind. I'm
there
just
won't be
confused.
there won't be any profit. There won't be any profit if they default. Why? Think about it.
Okay. Yep. That's a very good point.
Right. If they default, it's gonna be like this, right? This is the situation where they will default. So if this is like this, then they cannot even pay interest. Then that means their EBT, earnings before taxes, will also be negative. I mean, there can only be negative or zero, right? I mean, mathematically, if it is negative, we have to make it using if command. We have to make it automatically to be zero. I mean, if EBT is zero or negative, you cannot pay taxes, right? That means that means this is even less than taxes, right? You cannot even pay taxes, right? Then eventually net profit, EAT, is negative, right? So there's no profit for the creditors to take. But if your question is then what happens after default? Two things, creditors can give leeway. I mean, they can work it out. I mean, we'll let you slide this time, but I know you didn't make profit, so you can't pay interest, but we'll give you extension. So please, bring your company back to shape, and next time you pay both, the interest for the next semester, right? Because in case of bond, interest is semi-annual, right? Interest is semi-annual. So next semester, pay both the passed up interest, right? Passed up interest and the interest for that semester, and then and plus penalty rate. So the interest will be now it was 5%, but interest is now 7%. Okay, they will they will add penalty to that, and they will let the company go on. This is called workout. They work out a deal literally with the company. If there's no workout, what's going to happen? The creditors will take this company to the bankruptcy court, and they will get a bankruptcy judgment. Once they get a bankruptcy judgment, then they can seize hold of the assets of this company. Now you might wonder, there's no profit. These are two different things. Assets and profit you got to make. By now you should know. Profit is the result of the income.
That's more of what I was thinking about. I guess I was confusing. I guess like an income statement with a balance sheet, which is completely
different. On income statement, you may have negative profit, which is loss. But in the balance sheet, you have capital, especially first of all, current assets. Current assets will be used, but if they have no profit, but if they have interest to pay, they will have to use the current assets. And if they don't have any current assets, that's why they will default. I mean, if they still have current assets, right, they will liquidate the current assets and will try to pay the interest, right? But if they don't have, but default happens because they don't even have enough current assets to cover for current liabilities. And interest is current liability. Interest payment is current liabilities. So that's what all, that's where this, liquidity ratios come into play. That's why, where this liquidity ratio is coming into. So, so they don't have any liquidity. They don't have any. Then if they get the bank creditors, and the creditors will win, of course, in the bankruptcy court, because the law will. Paying interest is an obligation, right? Legal obligation. So they will get the bankruptcy judgment, and once they get the bankruptcy judgment, then they can seize hold of the physical assets. Like they can sell off, equipments, to recover their. But also think about it. That's called Chapter 7 bankruptcy, right? If they get the bankruptcy judgment and tries to liquidate fixed assets to recover their debt. It's not only interest, but also principal as well. The workout is called Chapter 11. Chapter 11 bankruptcy. Chapter 11 bankruptcy. They extend the terms. Yeah. Go. What was that?
Chapter 7 is much worse than 11, right? For most
companies. Yeah. Chapter 11 is like, workout, right? They work out a deal. They extend the terms, and they apply penalty rate and things like that. But the point is, question is, even if it is Chapter 7, think about it. The creditors will want to recover their principal and interest. Question is, if they liquidate all the fixed assets, their physical capital, the fixed assets, is it greater than or less than, right, the principal and interest? I mean, if it is greater than, if this is greater than, fixed assets are greater than liquidated value of fixed assets, then, I mean, if fixed assets, liquidated value of the fixed assets, in other words, dollar value of the fixed assets is greater than principal and interest, then yeah, they will go ahead and do it because they can recover their principal and interest. But if it is like is it my, I think, yeah, okay. If it is like this, there's no point in doing that. Isn't that right? If they can, at least if this is, think about it. It's all logic. It's not, it's not accounting. It's not numbers, it's all logic, right? I'm an economist. I'm not an accountant. I'm an economist. And as an economist, I analyze these things by logic, not by accounting practices, right? So think about it. If fixed assets, if you liquidate the fixed assets and they are at least like 80% of this, they may go ahead and, get, Chapter 7 bankruptcy judgment. And they sell, at least recover 80%. But if it is not even, suppose, if they cannot even, this is even, I mean, if they can recover fully 100%, they will do that. But, the liquidated value of, if the liquidated value of fixed assets is not even, 50%. It's not even 50% of the, not even 50% of their principal and interest. Will they go ahead with the Chapter 7? No, they won't, because it's like swallowing a poison pill, right? Isn't that right? No lender will swallow 50% loss. You understand? Make sense? The lender may swallow like 20% loss, up to 20% loss, but no lender will swallow up to 50% loss. Then if that's the case, it's better to, right, go for Chapter 11, right? Let the borrower leave, work, make money, and pay back. All, in other words, then, until they pay back, the share price will be zero because no profit goes to the stockholders, right? No profit can go to the stockholders. Under Chapter 11, all the profits that the company makes will first go to pay off the lenders. So until it is paid off, right, nothing goes to the owners, right? Stock price is literally zero then, right? Because there's no earnings, right, for the shareholders. Does that make sense? Yeah. Was it Richard? I mean, whoever asked the question, was it Richard?
Yes, it was me. It makes sense.
Okay, so it makes sense. Okay,
Yeah.
good.
Thank you.
Now, the time is already 11:36 again. So well, let's take a 10-minute break and reconvene at 11:46 then. Okay, that's righty. I got it. All right, we're back. We're back. So there are more cool things I want to talk about. More cool things about return on equity. I mean, how leverage. In other words, debt, right? Especially this is debt to equity ratio. Debt over. There are more cool things I want to talk about return on equity, but we'll have to move on to current liquidity ratios because we can come back to this later. We don't want to get bogged down, too much. So in liquidity ratios, right? Liquidity means cash flow, right? So in other words, companies can easily, I mean, not because they are lacking long-term capital. Long-term companies can default because of short-term capital. Short-term. The word is not short-term. Capital is not short-term. Inherently, there is no capital that can be short-term. What I'm talking about is short-term assets. Companies can go default because of lack of short-term assets. So first, excuse me a second. Well, I just hope I won't develop any cancer of the throat cancer because I teach 6 classes and every class my vocal cord my vocal cord will be damaged a lot, and then during the summer, right, I recover. But I also teach summer sessions, so I normally teach summer 2. During summer 1, I recover. My vocal cord recovers. So in current liquidity category, right? First one is current ratio, and current ratio is exactly the ratio between current assets and current liabilities, right? Remember I told you current ratio, right? I didn't put the word ratio because it's obvious. We are talking about the ratio variables. So just because I didn't, put the word ratio, if you think it is just called current, then that's also nonsense, right? And think about it. I told you most businesses are in danger of default, not because of lack of long-term capital, but because of the lack of short-term assets, right? The Chinese, property developer Evergrande, they were, a couple of weeks ago, that was the talk of the town, talk of the financial market. They are barely staving off default. They are barely staving off default, but it's not why. But it's not over yet. Why? And they are selling, their fixed assets. I mean, for a property developer, fixed assets would be what? The properties, right, that they own, right? Properties that they own. By selling off, and then obviously they cannot sell it in favorable terms. It will be all sold at they won't be even they won't even, get the full value on it because they are at the short end. If you are always at the short end, you are the one. I mean, there's no right. There's no the bargaining power is different, right? Between anyway, the point is, think about it. In the balance sheet, right, you have current assets and current liabilities. Current liabilities are the payments that mature within 1 year, and they within 1 year means some of the current liabilities become due tomorrow. Some of it becomes due 3 days later. Some of it becomes due in 1 week. Some of it in 1 month. Some of it in 3 months. They have all different maturities, and these payments must be met. And what is the source of funds to make that payment? It's the current assets. So the point is, the bottom line is, you must have. The bottom line is then, of course, you will have to have more current assets than current liabilities. But more current assets than current liabilities, if you think about it, the ratio between the two, I mean, if it is 1, what does that mean? If it is 1, you simply have, you just have exactly same amount of current assets as current liabilities. But is that good? No, it's not good. Why? Current assets is also working capital. In other words, if these numbers are the same, then after paying off current liabilities, you have nothing left for working capital. So basically, then you might wonder, so as long as current assets are greater than current liabilities, then that should be good. No, if it is greater than current liabilities, right, there are two possibilities. I mean, just being greater means this ratio will be greater than 1, right? If it is greater than 1, is it acceptable? No, this is not acceptable, right? The bottom line is it should be greater than 2, at least equal to or greater than 2. Why? If it is barely greater than 1, then still the same thing. After meeting your short-term payments, you will have you won't have enough sufficient working capital left, right? Working capital is what it takes to support your production activity until it generates revenue, until the output generates the revenue. Now, if you don't have sufficient, working capital, you can't do that. So the point is, it has to be at least greater than 2, right? If this ratio is 2, at least you can meet those short-term payments and then still have working capital left, right? The working capital, which is still the size of the current liabilities. So you're okay. I mean, the bottom line is it has to be greater than. The higher this number, the better it is. Now, the bottom line is 2. So this way you can tell. I mean, this is liquidity rate category, right? Liquidity ratio category. So this way you can tell whether the company will default or not. The next thing is quick ratio or acid test. Quick ratio, or also called acid test. Acid test, the name already implies some urgency about it. Yeah, it's about acid test is basically litmus paper test, right? I mean, of course, in chemistry, litmus, whether it is acid or not, litmus paper will change in color. But why is it called quick ratio? I mean, why is the quick ratio? It's quick, and it's also called acid test. This is basically current assets minus inventory over current liabilities. Now, if you think about it, inventory is part of the current assets, right? I don't even have to go back, but this is another. I'll simply open another. Everyone remembers that, right? Everyone should remember. Did I close it? I just close it as I was opening? What's going on? Yeah, okay, it's there. So, look, one of the current assets are also called liquid assets. I've been telling you, current assets are also called what happened? It's all scrambled and rearranged. You see, interesting thing is cash and cash equivalents, marketable securities, promissory notes, accounts receivable. They are all literally liquid assets, liquid financial assets, right? There's a financial market already, right? There's a market for to liquidate all of this. I mean, cash is already cash. You don't have to liquidate, but stocks and bonds, promissory notes, accounts receivable, there's a market to liquidate them. But inventory is not, it's part of the current assets, but they are more physical in nature. They are physical in nature, right? Because it's raw material or finished goods or goods in process. So that means there is no standardized market for this. There's no standardized marketplace for this. I mean, you can sell, but it will take time. It will take time to liquidate the inventory, right? It will take time to, and usually, you might wonder. I mean, a dollar store, right? 99-cent store. I mean, it used to be 99-cent store. But in the 1960s, even until 1960s, there was a dime store, nickel and dime store. Nickel and dime store in the 60s, 50s and 60s, turned into 99-cent store in the 80s and 90s. And then these days, it's dollar and above, right? But you might wonder. You must have wondered, how can they sell it for 99 cents? How can they sell it for 99 cents? It's all, on these are basically unsold inventory of some manufacturers or some retailers, unsold inventory. And unsold inventory is a burden to these companies. I mean, because it's sitting there, so it's better to sell them even at deep discount. And hence comes in the liquidators. Liquidators are the companies that specialize in buying these unsold inventory in large quantity at very deep discount and resell it. Because of the liquidators, there can be 99-cent stores, right? Those who supply these goods to the 99-cent stores, those are the liquidators, okay? But what that means is, it takes time to liquidate inventory, right? It takes time to liquidate inventory. So think about it. It will take at least a month, 3 months to liquidate the inventory. But then let's say you have urgent payment to make by the end of this week, or tomorrow, or 3 days later, in 3 days, or in 3 days. In that case, you cannot include inventory, right, in the numerator. So you subtract the inventory, and then all of this current assets minus inventory will be all literally financial assets, liquid financial assets. Financial assets. So it can be quickly liquidated. Hence, quick ratio or asset test. And the bottom line for this number is literally it's 1. 1. It can be greater than, equal to. It can be equal to, but it must be greater than 1. Right? That way, after making those payments, meeting those obligations, still you have it can take 1 month or to liquidate the inventory, but you will have working capital, right? So that's the current ratio, and this ties in together with say that again. Was someone saying something? All right. So then, this ties in together with, Richard's question. Richard's question was, if the company defaults, it will default if they, so whether it's going to default or not, you will check these ratios, right? The current ratio must be greater than 2, and the quick ratio must be greater than 1. And if it is not, right, if the quick ratio is less than 1, or if the current ratio is less than 2, the company will default, right? All right. And then asset management ratio. Third category is asset management ratios. Oh no. In asset management category, the first ratio is inventory turnover ratio. Now, if you think about it, yes, inventory, it came up a while ago. Inventory turnover ratio is actually And what does the inventory in this case means, finished goods. You remember inventory can consist of three types. If you are a manufacturer, the inventory could be raw material, goods in process, and finished goods, right? That's the case of manufacturer. But in case of retailer, inventory consists only of finished goods. Isn't that right? There's no retailer that has raw material or goods in process, right? Excuse me a second. So in retailer, right? In case of retailer, inventory turnover means how many times your inventory gets sold. So you replenish the inventory. I mean, for example, let me give you inventory turnover ratio is basically measured by revenue over average inventory. And what is average inventory? Average inventory is basically beginning inventory. Beginning inventory. I'll just call it BI, beginning inventory, plus ending inventory, divided by 2, right? That's the average inventory. So if you think about it, let's say your average sale on a regular month, let's say your average sales revenue is, suppose you have a retail store, retail business, and on an average on ordinary month, average revenue, sales revenue is, let's say, 200,000, right? On an average so on average month, right? Average monthly revenue $200K. And then if you have, so you would normally keep when you begin the month, you would normally keep just about $200K, $200,000 worth of inventory. So usually when you start the month, you will have beginning inventory, right? And what is beginning inventory? Beginning inventory is literally beginning inventory is, let's say, 50K. You have, and that's the inventory that you already had when you start this month. So actually, this is the ending inventory of the previous month. Isn't that right? Beginning inventory of this month is the ending inventory of the previous month and is carried over, right? Which is carried over to the current month. And you know, 50K is not enough to meet your average monthly sale. So what do? You will order, right? You will order, just about either, 50. You will need to order something like 150K or more, right? Or more, 150K plus, to meet the sales projection, because it's average, monthly revenue. This is called what? This is called net purchase. Right? This is called net purchase. And beginning inventory plus net purchase is called what? So think about it. You had already 50K as beginning inventory, and you have 150K. So this total is like 200K, slightly plus, because you may have, ordered a little more, and that's called GAS. What is that? What does that mean? Anyone? What does GAS stand for?
Is it goods and services? I don't know.
Goods available
No.
for sale.
Yes, goods available for sale. Yes, who was that? Anna?
Anna.
Was it Anna?
Yeah.
Who said goods available for sale?
Anna, me.
Okay, Anna. Anna, so you got another 0.25. Yeah, literally. I mean, that means, if you have a total of 200K in merchandise, right? That's for sale, right? That's to sell during that month, during that particular month. But that's literally goods available for sale, the merchandise available for sale. And then after that, what should happen? So you have goods available for sale, right? Which amounts to 200K. What happens next then? What happens next? Look, you have a business, you have a store, you have $200,000 worth of merchandise, right?
Sell it.
Yeah. In other words, sale happens next, isn't that right? What should happen next is the sale, right? But the sale is come on. Okay. What happens next is sale, which is revenue, basically. Sale is revenue, isn't that right? Result of sale is revenue. And the revenue is, so let's say you sold, 180, let's say 175K this month. So you sold, revenue is 175. And then if that's the sale, then that means 25K is left unsold. Isn't that right? 25K slightly plus, right? Slightly 25K plus, right? That's left unsold. And what is that called? 25K is called what then? Come on, this is just logic.
That's the beginning inventory for the next period.
Yes, but for this period is called, it should be called for this period, that's called.
Is it turnover?
What?
Is it turnover?
Turnover? No.
Uh,
Turnover means, changeover, right? For this period, it should be called what? That's the ending inventory, isn't that right? For this period, my computer is slow.
Professor,
Yes? It's
I hate to be that
12:15
guy
again? Oh, it's
Yeah.
12:15. Yeah. Thank you for reminding me. All righty. So we're going to have to continue this. Turnover means how many times does this happen? I mean, let me just be brief. If our sale was only about 200K, just about average level, then there's no turnover. I mean, turnover is just once, right? But if our sale this month was like 600K, what does that mean? You had to you had to reorder 3 times. You had to reorder 3 times, right? In other words, your inventory turned over 3 times. That's what is meant by turnover, right? Customer turnover. I mean, what does that mean? If you have a restaurant, it's 12:50. So I'm going to talk more about this in the next class. Okay, our time is up. So I will see you guys. Don't forget the midterm. I will see you guys next Saturday. All right. Have a great weekend, everyone. All righty. Take care, Richard. All right. You too, Anna. All righty. Take care, everyone. I will stop sharing and stop recording and sign out.